Hello viewers, welcome back to UPSC Warriors channel by Unacademy. This is Sounddharya. We have successfully completed our 3 MCQ series on the topic money. So today we are going to start with a very new but very important topic, that is your monetary policy. So every year you can expect at least 2 to 3 questions being asked from these two topics alone in your UPSC prelims. So without much delay, let's begin with today's questions from the topic monetary policy, where you will have to study about the role of RBI in controlling inflation, the role of RBI in maintaining or ensuring the economic growth. Okay, so the role of RBI with respect to credit creation, the role of RBI with respect to regulation of the financial systems. So all these things are part of this monetary policy. It mainly deals with the flow of money, supply of money, control of money, inflation and everything. So the first question is about RBI's devaluation and the open market operations. So let's read it now. With reference to the Indian economy, consider the following statements. The first statement says, if the RBI devalues Indian currency, it is likely to buy government securities. So you have to give focus to two things. One is devaluation of Indian currency. On what circumstances the RBI will go for devaluation? That is decreasing the value of Indian currency with respect to any foreign currency. And second thing, it is likely to buy the government securities. So buying and selling of government securities will fall under the open market operations. Okay, so you have to relate this thing to these two elements. We'll come back to that later. Now read the second statement with me. If the inflation is too high, the RBI is likely to sell the government securities. So when the conditions of inflation is very high, the RBI will go for selling of government securities. And third statement says, if the interest rates in the USA fall, then the RBI reduces the policy rates in India immediately. So let's try to understand the statement one now and try to find out whether it is correct or not correct. If the RBI devalues Indian currency, it is likely to buy government securities. Here you have to know about two things. On what conditions RBI will go for devaluation of Indian currency? So what is devaluation of Indian currency? Making $1 is equal to 90 rupees from probably $1 equal to 85 rupees. So this is something called as devaluation. So why do the RBI will go for devaluation? It will do devaluation so as to promote exports. It will go for devaluation so as to reduce your imports. How? When the value of Indian rupee is getting changed from 85 rupees to 90 rupees, then it means that if I am an exporter, for every dollars that I earn in the international market, I will be able to get 5 rupees extra. So this is something that can help in promotion of exports. And if I am an importer, for every dollar that I have to spend to get the product from abroad, I will have to spend 5 rupees extra to get $1. That is something which is likely to reduce the imports. So this is something which is done not on a regular basis but occasionally, whenever the conditions are not that good, whenever the rupee value is continuously appreciating. On those circumstances, the RBI can actually go for devaluation. But now, how this devaluation is something that is going to impact the other segments of the economy, especially inflation. So to understand this, we have to know how RBI is actually devaluing the Indian currency. See, this kind of action can be done by the RBI in such a way that it is actually helping in reducing the value of Indian currency. How it is going to do that? In order to increase the value of and decrease the value of Indian currency, it should probably increase the value of the foreign currency. Say for example, dollar. So if we take dollar in this case, if RBI wants to go for devaluation, the first thing that it will do is it will decrease the supply of dollars. How? Whenever the supply of dollars is getting decreased, okay, so that is something which is not able to match the demand, the value of dollars will increase. When the value of dollar is increasing, the value of Indian rupee will decrease, right? So how the RBI can decrease the supply of dollar? by simply purchasing dollars from the market, from the exchange banks, right? So when the RBI is purchasing all the dollars that are there in the market, that are there with the exchange banks, that is going to create a, a shortage of dollars in the market, obviously resulting in increasing the value of the dollar. But there is one more thing that is associated with this. If the RBI wants to purchase dollars from the market, it should pay rupees, right? So that is something which can lead to increase in the supply of Indian rupees. So this is something which is likely to result in increase in the supply of Indian rupees. So whenever the supply of Indian rupees are getting increased, this condition is something that is likely to lead to inflation. That is, if the money supply in the market is getting increased, it can lead to what? Condition of inflation. So if the government really does not want to increase money supply so as to, tackle the inflation related issues, what it has to do? Following the devaluation, the RBI should actually do something so as to absorb the excess rupees that it injected into the market while doing this devaluation process. Yes or no? Now what the RBI can actually do to absorb this excess supply of Indian rupees in the market? The RBI can actually borrow from the banks. Okay, so if the RBI is borrowing from the banks, if the RBI is able to get the excess Indian rupees that it has injected into the market, that is something that can actually reduce the inflation, reduce the money supply, right? How RBI can borrow? RBI can borrow by selling the government securities. So whenever the RBI is selling government securities, it is like pledging the government securities to the banks to get the loan. So RBI will sell government securities to the banks and get loan in return. That will help RBI to absorb the excess rupee that it injected into the market. So this kind of activity, that is selling the government securities or buying the government securities, will revolve around or will be determined by the economic conditions that prevail at that period of time. If at all the RBI is going for devaluation of currency, it should probably end that process by selling off the government securities so as to absorb the excess liquidity in the market, so that it is not leading to inflation. So this operation of doing selling of government securities followed by devaluation is something called as sterilization. Okay, so this process of going for open market operations where the RBI is likely to sell the government securities followed by devaluation is called as serialization. Okay, so now read the statement. If the RBI devalues Indian currency, it is likely to buy government securities. No, after devaluation, if the RBI is buying government securities, it means what? It is granting loans. It will again lead to injection of more rupees into the market. So this is something which the RBI will not do. Okay, so now the statement 1 is incorrect. Let's try to understand what the statement 2 says here. If the inflation is too high, the Reserve Bank of India is likely to sell government securities. It is very simple, which we just saw a few seconds before, right? So this statement is correct. So whenever there is inflation, even without thinking about devaluation or revaluation, whenever inflation is happening, RBI can do this. Just sell the government securities and absorb the excess liquidity that is there in the market. Next, moving on to the third statement. This is a very interesting statement because if the interest rates in the USA fall, then the Reserve Bank of India reduces the policy interest rates immediately. Have you ever thought of this? What is likely to happen in India whenever the US is reducing its rates? So immediately after the 48 hours of Trump getting elected, the US Federal Reserve actually decreased their interest rates by 65 base points. So likely to signal that the inflation is going to be under control, and it is the Trump's rule, drill baby drill. So anything can happen in US. But how it is going to affect the Indian economy? See, if the interest rates in USA fall, according to the statement, it says RBI will also drastically reduce the, not drastically, but reduce the interest rate immediately. This term is something which makes the statement incorrect. Of course, the RBI can go for reducing the interest rates, but it is not necessary for the RBI to do it immediately. It again depends upon other conditions like how our inflation is actually, and what is the status of economic growth, whether we are in the growth phase or whether we are going through stagnation, and there are so many other factors to consider. But how decrease in interest rate in US is going to impact India? It is going to impact India in two different ways. The first thing, whenever the interest rates of US banks are getting decreased, then it means that the cost of borrowing, okay, whenever the interest rates of bank is getting decreased, it means that the cost of borrowing is less. Okay, I can purchase dollars as loan, for lower interest rate. This is something that can help me when I am able to purchase dollars for lower interest rate and invest those dollars in the countries which have higher interest rates. Why? It is because if the interest rates are higher, if I am investing in the country, then obviously I will be able to get higher returns, right? So this kind of activity, by making use of the interest gaps between two countries, is something called as a carry trade. So I'm introducing a new term here. So what is meant by carry trade? It is an investment strategy where an investor borrows money in a currency with a lower interest rate, say for example dollars, and invest in another currency that offers higher interest rate, that is Indian rupees. The investor does with the aim of profiting from the interest rate differential between the two countries. Although it is going to help India with inflow of investments, it is something which is not that good. Okay, why? It is because we have huge amount of capital flows into India that can something lead to appreciation for a longer period of time, and when the rupee value is getting appreciated continuously for a longer period of time, that can affect our exports. So this is one thing. So that is why the government will try to, I mean the RBI will also try to reduce the interest rates when the interest rates of countries which are that impactful like US is actually getting decreased. But this is not something which is likely to happen immediately. So then this statement is incorrect. Now what is the question here? The question is to find the incorrect statements. 3 is incorrect and 1 is incorrect. The correct answer is option C, 1 and 3 only. I hope this is clear now. Let's move to the second question. Consider the following statements with reference to marginal standing facility rate. You can see this type of questions being asked in UPSC, where you will be asked about what is bank rate, how it is different from base rate, what is this marginal standing facility. Okay, so whether it is going to be higher than your repo rate or not, and you have some set of interest rates to be taken care of as part of the RBI's monetary policy, about which we will be studying in the further classes, like what is repo, what is reverse repo, how they are different from each other and everything. So this was based on your previous year question. This is about the marginal standing facility. So according to the first statement, it says that it is the interest rate at which banks borrow from the RBI in emergency situation. Okay. Second statement says the MSF rate is placed at 25 basis points above the policy repo rate. And third thing, under MSF, banks can borrow funds up to 1% of their net demand and time liabilities. So it is basically asking you to have a clear understanding of what this marginal standing facility is all about. See, it is the rate at which banks borrow from RBI during emergency situation. This is something correct. When all other windows are closed, that is the mechanisms through which the interbank buying and lending takes place are done. And if the bank is having some kind of emergency situation and when no other options are available, then the bank can use this mechanism to get loan from the RBI, and that is why this is called as a penal interest rate, so that in order to ensure that banks don't use this mechanism often, the interest rates will be quite higher than the normal repo rate. Okay, so how much? It is 25 basis points higher than the normal repo rate. And third thing is that under MSF there is another limit or restriction that says that banks can borrow funds up to 1% only of their net demand and time liabilities. So what is the correct answer here? It is all the above. The question is asking you to find out the correct answer. It is all the above. Moving forward to the third question, we have totally 5 questions with us today. Dear money policy, as seen in news sometimes, refers to which of the following? Okay, so we will often come across terms like dear money policy, accommodative stance, withdrawal of accommodative stance, neutral stance, hawkish, and dovish, policy, expansionary, contractionary policy, etc. So it's needed for us to know the meaning of these terms. That's the purpose of having this question here. So when RBI is taking dear money policy in hand, what it actually means: decreasing the policy rates by RBI, increasing the policy rates by RBI, withdrawal of accommodation stance, and contractionary monetary policy. These are the different types of monetary policies that the RBI can follow. Of all these things, dear money policy is something that will increase the money supply. That will increase the policy rate in the bank so as to control the inflation. Okay, it is like this. The RBI is telling the banks, dear bank, don't worry, I'm so sorry for doing this. I'm going to increase the interest rate. When the RBI will do such when the RBI will take such monetary policy in hand, when the inflation is not under control, when the RBI wants to decrease inflation or take care of increasing money supply in the economy, it can go for higher interest rate that will make the cost of borrowings very high, and obviously that can help in reducing the money supply. And I'm going to introduce you to the other two terms related to this, that is hawkish policy. So when we say that it is taking a hawkish policy, it means it is having a sharp high on inflation. So the primary objective of hawkish policy is to control the inflation. Again, here the RBI is going to increase the interest rate and not decrease it. And talking about, even it means slowing down whenever the interest rates are not decreased. Obviously the cost of borrowings will be less, so the investments will be less, the economic growth will be less. But even if the economic growth is going to get slowed down, that doesn't matter, but I don't want inflation in my country, so then we can go for hawkish policy. And again, all these policies depend upon the current economic situation that is actually there. And the dovish policy is something totally opposite to this hawkish policy. It's quite liberal, and here the interest rates will be lowered so as to enable production, so as to enable borrowing, so as to enable job creation in the economy. And you can also have a look at these terms. Talking about the neutral stance. So whenever the monetary policy meetings are happening, have a look at the minutes of the meetings in the newspaper. Whenever we have this neutral stance in place, it means that the RBI can either go for increasing the interest rates or it can go for decreasing the interest rates depending upon the conditions prevail. And then talking about withdrawal of accommodation, it means that under the withdrawal of accommodation, or if the RBI is taking withdrawal of accommodation stance, it means that the RBI is not going to decrease the interest rates. Okay, so this is something which is aimed to reduce the money supply in the economy by giving more restrictions to borrowings. And what is the accommodative stance? It is the opposite to this withdrawal of accommodative stance, where the chances are there for the RBI to decrease the money supply so as to increase the borrowing, stimulate economic activity as well as growth. Okay, so now moving forward from here, so what is the correct answer? Dear money policy is in news sometimes refers to increasing the policy rates by the RBI. And then we have next question, that is the fourth question. Consider the following statements. and expansionary monetary policy decreases the unemployment. So when we say expansionary monetary policy, it means that the government will spend more, RBI will reduce the interest rate so as to stimulate growth and production in the country. So when the growth is stimulated, chances are likely for increased production. So when the productions are getting increased, the unemployment will also get decreased. So this statement is correct. It decreases unemployment. And read the second statement. Higher money supply and attractive interest rates stimulate business activities and expansion of the job market. So this is the explanation which I gave right now. So we have to select the correct code from below. This is again a different type of question patterns you'll find in UPSC. So here the statement 1 is correct and statement 2 is the correct explanation of statement 1, and this is your correct option. Okay, so the statement 1 is also true and statement 2 is the correct explanation of the statement 1. So this is a very easy question. Moving forward from here, we have the last question for today. Which of the following measures fall under the ambit of Monetary Policy Committee of India? So creation of public repository of digital lending apps, increased frequency of reporting of credit information to credit information companies, enhanced transaction limit for tax payments through UPI, introduction of delegated payments through UPI, changing the repo rates to the controlled inflation. So what are the surveys or the activities that the Monetary Policy Committee can actually do? So the answer lies in all of the above. Okay, see, the Monetary Policy Committee is something which was set up to control inflation and maintain economic growth. As part of its agenda, it has so many things to do. That is, here as it is written here, take the policy measures in hand, that is deal with reducing or increasing the interest rates, and then go with GDP estimations, growth projections, and then CPI inflation forecast, and so many things it can do, right? So this is entrusted with the task of what? Fixing the benchmark policy rate so as to contain the inflation within target. And it includes members like RBI governor, it includes members like RBI deputy governor, and one official nominated by the RBI. So totally 3 members from RBI and remaining 3 members from the government of India. So what is the correct answer here? It is option D. That's it for today. We have completed the first series of MCQs from monetary policy. I have an announcement to make here. That is, you can use my code RIYA50 to avail the UPSC CRC subscription of Unacademy Plus platform for just rupees 24,999, where we will have classes being conducted by the top educators in not just English batch but also in English batch and completely Hindi batch. So that's it for today. Thank you so much for watching. If you have not subscribed to UPSC Warriors channel, please subscribe. If you like this video, please like, share and comment. See you all in the next video. Bye-bye.